Welcome to today's webinar, the fifth webinar in IFAI's series of scaling up trainings discussing agricultural production tools and economic forecast models to help build strong tribal food businesses and food systems throughout Indian country. This webinar will provide an overview of common legal structures for business operations and detail the benefits and risks involved with each structure. This training will also provide insight into the business entities section of the Model Tribal Food and Agriculture Code, a resource developed for tribal governments in the form of a comprehensive set of model laws for review, adoption, and implementation. The model laws contained in the code were designed by the Indigenous Food and Agriculture Initiative and contributing attorneys to facilitate agricultural production, food systems development, and healthy outcomes improvement in Indian country. Before we get started, I want to go over some quick housekeeping. All attendees will be muted during the presentation. However, you can use the control panel to submit questions using the questions dialog box. We will have time set aside toward the end to answer those questions. Also, a quick note, we will also be posting this webinar recording on our Indigenous Food and Agriculture Initiative YouTube channel and follow up with an email that includes the webinar recording and the PowerPoint presentation slides that I'll be going over today. With that, I will give you a quick introduction. My name is Blake Jackson, and I am an attorney at the Indigenous Food and Agriculture Initiative, and I will be providing a brief overview of these, and we can get started at this time. Our team at the Indigenous Food and Agriculture Initiative consists of Colby Duran, who is our director, Aaron Parker, who is our research director and staff attorney, myself, Blake Jackson, I'm the policy officer and a staff attorney as well, and our most recent addition is Whitney Sani, who is our communications director. And our founding, we started in 2013 in the University of Arkansas School of Law, and we were co-founded by then Dean Stacy Leeds and our founding director, Janie Sims Hip. We have since moved out of the law school. Now that the Dean Leeds is now Vice Chancellor Leeds, we have moved with her to the Office of Economic Development, which is a recent development, but it kind of aligns with our mission of enhancing health and wellness in tribal communities by advancing healthy food systems, diversified economic development, and cultural food traditions in Indian country. So our new move is aligned with our mission, and it kind of provides another platform for us to exercise the work that we do within Indian country, specifically with regard to food and agriculture. We kind of to kind of recap the work that we do and kind of put emphasis on things. We provide strategic legal analysis, policy research, and educational resources to empower Indian country through food sovereignty, agriculture, and economic development. And so we kind of think of it as a three-legged stool when we kind of put all these things together, because food sovereignty, agriculture, and healthy economies in Indian country surrounded around those aspects kind of all work together in putting this there. But this is all exercised through healthy relationships and also healthy economies in Indian country by exercises of tribal sovereignty and tribal self-governance. So when we really think of our work and what we're trying to cultivate in Indian country, we think of it as putting the tribal sovereignty within the larger movement of food sovereignty that we see in the current day. So if we're trying to summarize what we do, that's a pretty good overview of the work that encapsulates. In addition to the work that I'm going to kind of showcase here in a second. Some of the larger projects that we've done, we are the FDA Food Safety, the Native American Tribal Training Center for Food Safety Outreach, Education, Training, and Technical Assistance. This is a cooperative agreement that we have with the FDA to conduct food safety training regarding the produce safety rule of the Food Safety Modernization Act. And under that agreement, we provide trainings to tribal growers if you can get 10 growers together to go over their compliance under this act. But also we're in the process of developing an alternative curriculum specifically for tribal audiences and trying to incorporate more of that underlying science and make it in a culturally appropriate training. We use the training that was provided, but we're tailoring this to some of the things that our trainers have seen going out and doing this. Another project that we've worked with that I'll go over more is a model tribal food and agriculture code, which is a model set of laws for tribes to adopt in facilitating agricultural and food production within their jurisdictions. We've hosted several food policy roundtable discussions throughout Indian country. We provide policy support to the National Association of Food Distribution Programs on Indian Reservations, which is an association of uh, the administrators for the FDIPR program at the tribal level, some know it as the commodities program, that have gotten together to discuss the larger issues that entails, and we assist with those efforts and helping them with the tribal consultations and making sure that the research is there for them to have that when they need it. Something that we're in the process of this week is we're hosting our annual Native Food and Youth in Food and Agriculture Leadership Summit. This is something that we started 6 years ago at our founding, and we bring approximately 40 students on campus to go over different tracks of career development, specifically in the areas of food and agriculture here at the University of Arkansas for a week. The Scaling Up project, which is kind of a training training series that we do, and some projects that are incorporated in that kind of help tribal producers wanting to take that next step in Indian country, kind of making them aware of the economic and legal risks with doing that and what kind of compliance they'll need to scale up their business in a successful way so that it has sustained growth going forward. And also, we are the research partner for the Native Farm Bill Coalition, which is a conglomerate organization of 170 tribes and tribal organizations that have gotten together to kind of collectively put forward their ideas in the Farm Bill and with respect to that, and some areas of child nutrition that have had a big voice in the 2018 Farm Bill, getting 63 tribal provisions in there, which was a historic number for Indian country. And so as needed, we step in and do the policy research for them as a research partner for that organization. Something I'm going to go over today with this is the tribal business entities section, and this is the subset of the Scaling Up project that we've discussed. But I do want to go over a few things before we get going. There are a lot of different ways that you can set up a business within Indian country. Now, I will say that this is provided in the context of food and agriculture with agricultural businesses and food businesses, but you'll see a lot of these themes overarch into other areas of tribal governance and also with individual business creation. So it's important to know that this is part of a larger discussion, but there are some specific things to discuss in regard to ag and food. And it's, like I said, it's a very tailored approach. So in doing this, you will see that there is a lot of versatility to the way that you go about setting these up. There's different entity structures, and it's largely going to depend on the goals of the tribal leadership that are trying to set up a food business. If it's a tribal business, or if it's a individual business, what that individual producers or the entrepreneur's goals are. So you see a lot of different structures that differ from tribe to tribe, or even if it's a larger tribe and there's different things that they're trying to accomplish within their economic portfolio, you might see different business structures set up trying to accomplish those end goals within the same tribe. So there's a lot of different options to pick from in doing this, and you'll see that kind of throughout this presentation. And in doing this, there are some things to keep in mind. And a lot of these are legal implications. For one, if you are setting up different types of entities, and you're trying to do this as an exercise of tribal governance, it's important to keep in mind what that could do for that business. If that business is going to share in the tribe's sovereign immunity, you're going to have an overlap between that being under the body of the tribe or having a very close association with the tribe. In a lot of jurisdictions, there are some case law out there that does say that if you incorporate under state law, then you've chosen to subordinate yourself to another sovereign because you would be doing that under the laws of the state, and your business might not enjoy the tribal sovereign immunity that it would if it were more closely held to the tribal government or done under tribal law. So that is something to keep in mind with local counsel if you're trying to do that, and with tribal attorneys. So that's an issue to flag if you're looking to engage in that. Another one is the tax implications of that. If you incorporate under federal law, you might get certain breaks, but you might, and each entity is taxed differently. Some are pass-through entities, some are taxed at the corporate level. And so kind of figuring out how you want your tax structure to be set up, or things to keep in mind in conversations with possibly a legal professional or an accountant in consulting and doing these things going forward. Access to funding is also another issue to keep in mind, because if you have a business set up for profit, you're going to be looking for a different a different revenue stream than you would say if you were setting up a not-for-profit business. As you can do more, you can secure more government funding and things with the latter. But as with a for-profit business, a lot of those grants and whatnot are kind of cut off. There's different formation costs. You know, if you're going to consult a local attorney or a financial professional, if you're going to have to pay a filing fee with the Secretary of the State, or whatever filing fee the tribal government might set up. Those are things to be cognizant of. Individual legal liability is also going to differ from structure to structure, because some structures provide what we call limited liability, in that the people that get together and form these businesses are not going to be liable for any of the financial obligations of the business. They might only lose up to what they had invested. But if there's general liability, then each person that has gotten together to form an entity may or may not have the limited aspects of liability, and they can all be held jointly liable for the obligations of those businesses, and one's a partnership, which we'll get into. Outside regulation, again, if you're going to go engage with the state, you might have state actors and state regulators in your business if you decide to register that way. There's also different things to keep in mind with political considerations. You know, if you have tribal leaders sitting on a board and there's a tribal election that turns over, but their term's not up on the board, you might have a different kind of relationship to manage than previously. And also, you know, as with that, there is that attenuation or that closeness that you might want to consider if you're setting this up as a tribally owned business, between, you know, the politics of overlap of office, or the turnover of office, and how much attenuation do you want to keep with these things, keeping your economic development separate from those transitional times that can happen with governmental turnover. So that's something to keep in mind going forward. Again, something else to know is internal and external relations. There are multiple actors and jurisdictional overlays. Different federal laws apply with taxation specific to tribes as well. Again, state actors, for instance, if you were to incorporate a not-for-profit business, maybe a 501c3 under state law, a lot of times that's because the responsibility there is to the public, and a lot of times the state attorney generals are the ones that are involved in enforcing that kind of consumer protection aspect. So if you were to set up a tribal nonprofit, but you were to do it through state law, there might be unintentional consequences of having a state attorney general involved if something went bad, and you might not want that in terms of your governmental structure. And also keeping knowledgeable of the different tribal laws that exist in doing this. And there's different incentives too, depending on the structure of your ownership. For instance, if it's a tribal member-owned business, you might be able to enjoy certain relationships with the tribe's procurement department if you're trying to sell some of your goods to maybe to a tribal government or another tribally owned business that's under the governmental structure, and getting some sort of preferred vendor there. There's also maybe an advantage to having an individual Indian who's a member of another tribe there to get some of those preferred vendor relationships, if those exist under tribal procurement regulations or not. But again, also know that if you have a majority non-Indian business, you might be subject to additional jurisdictional inquiries that go on. A case that we saw a few years ago was the Dollar General case that went all the way to the Supreme Court, in which a non-Indian business came into tribal land, got a tribal business license, and had leased land from the tribe. And there was an incident involving a tribal youth employee arising out of that relationship. And the jurisdiction was a large question that was litigated there, because it was a non-Indian owned business. And so there's limited instances to where jurisdiction in the tribal court might be exercised over that non-Indian ownership structure. So that's something else to keep in mind. If it's a profit or a non-profit, you know, a profit is kind of dividing of proceeds, and with that, the liability that comes with that, proportionate to that. And also, if it's a not-for-profit business, you've got to think about what kind of constituency are you wanting to serve, what kind of cause is everybody getting together for. And when I talk about that, the thing that you've got to keep in mind is mission creep. If you have a not-for-profit entity set up in a certain way, it has to be within the scope of that entity's mission. Otherwise, if you get beyond the individual mission that you've set up and you've got 501c3 status with the IRS, making it a tax-exempt business, and you creep beyond that mission, sometimes that could put your 501c3 status in jeopardy with the IRS. So these are things to keep in mind and to kind of guide the discussion today going forward. So just keep those things kind of at the tip of your hat if it sparks any questions here toward the end. So with that, we'll go forward. This is the list of tribal business entity structures that we will cover today. We'll go through the sole or individual proprietorship. We'll go into a partnership, which is sometimes called a general partnership, going through a limited partnership, limited liability partnership, a limited liability company, and we'll go and provide a general overview of corporations. And with that, there's two that I'm going to focus on: the private for-profit corporations and the not-for-profit corporations. And beyond that, we'll discuss the not-for-profit membership association. And lastly, we'll conclude our entities discussion with an overview of agricultural cooperatives, which are very common throughout agricultural business setups. And we'll conclude with a brief discussion as we discussed in the intro to this training with the Model Tribal Food and Agriculture Code. If you're a tribal leader looking to figure out how you can get some law on the books, if you don't have this in your tribal code already to facilitate setting up these structures, we can go over the business entity section of the Tribal Food and Agriculture Code that we've developed to kind of start maybe some of those conversations or implementing that within your own tribal governance structure. So with that, we'll kind of get going here with the sole proprietorship or the individual proprietorship. I call it a sole proprietorship just kind of by default because that's the way I learned it. And it's easy to think of this as maybe just an individual doing one thing in a trade or business. If you're doing something alone, maybe you're just selling something at the local farmer's market. It's an individually owned business in which you have the sole control over the management of that business. But with that, you also have unlimited personal liability for the debts of the business because you yourself are the business. There is no separation and there's no separate legal structure. So the thing here is that these are very simple to create and maintain and end. There's no special filings or reports or no formalities to terminate it because the business is you. And there's no accountability or reporting to a board of directors or stockholders or members or managers or partners for that matter, because again, you're the one in the driver's seat of this business. But the thing that kind of comes with that is you don't have to share the profits or losses with anyone, but the risk comes with that, with all that control, is that you are individually liable, that if something was to go wrong with your business and you were held legal, your business was legally responsible, there is no separation, there's no veil between your personal assets and those business assets because this is 100% you. Some state and tribal laws allow for the sole proprietor to claim exempt certain property from the legal process, like the homesteads, household goods and furnishings, cars, tools, equipment. So for instance, if you had a sole proprietorship and you had to declare bankruptcy and it was part of your personal assets, sometimes you get to exclude these from bankruptcy. If you're trying to declare bankruptcy here, you would get those exemptions depending on what your state law allows. And there, like I said, the disadvantages here is that there is that unlimited personal liability. You can't really transfer it because it would be your own business, and there's hardly access to capital is an issue because outside investors don't really have protection if things were to go badly. And again, because you are the business will terminate on your death. So those are some that's an overview of that entity structure and the way that can kind of come forward and way it will transfer at the end of your life if that were the structure you adopted. Another instance in which there's an organization is that a general partnership, and sometimes just called a straight partnership. And it's an association of two or more persons to carry on a business as co-owners for a profit, regardless of whether or not that's intended to form a partnership. And there's no filing or any formalities required with the Secretary of State. So all basically what would happen is if two people got together and said they wanted to run a business as a partnership, that's it. That's all it takes to establish that. And a partnership is it's its own legal entity distinct from its partners. So state and tribal law can impose the terms of a partnership. If there isn't what we call a written partnership agreement, some states allow for these to be oral agreements, but as with any risk adverse attorney, I would say that you would need to put it in writing. That way everything's memorialized and there's a limited debate as to what was discussed in the formation of these items. Now, the thing with a partnership is that each partner is personally liable for the obligations of the partnership, and they can be held what we call jointly and severally liable under the law, meaning that they are each responsible up to the whole amount. And each partner has an equal say in the management unless the partnership agreement states otherwise, if there is one. And again, each partner shares equally in the profit and losses unless there's an agreement to provide otherwise. So it's kind of that structure that provides kind of a bare bones, but there's not much of a overall protection in this. The partnership files a tax return, but it's not a taxable entity itself. Instead, a partnership is treated as a pass-through entity where the partners pay a proportional share of taxes from profit or losses as part of their personal income taxes. So if I got together with another person and we formed a partnership, the entity itself wouldn't pay the taxes, but if we both split the earnings 50-50, that's attributed to me as personal income, and I would pay that as part of my personal income taxes to the state or to the federal government. And again, there's no special formalities. That's an advantage here. Simple to create and maintain. You can transfer the interest in a partnership, and the tax treatment is fairly simple. But again, there's unlimited personal liability, and management is more difficult because you need to consult your partners, because the assumption is that everyone has equal opportunity in management. And also with that, each person can individually bind the partnership as a function of what we call agency, because each person has equal management authority and can sign contracts on behalf of the entity. The next entity that we'll cover is the limited partnership. And this is, think of, you have your general partnership, but this is another layer of a partnership to where two or more people get together and form a partnership. But if we have two or more general partners, or one or more general partners and one or more limited partners. So there's two classes of partnership here. A general partnership has just the general partners, but you have kind of a tiered system here. You have general partners and you have limited partners. And this is formed by filing a certificate of limited partnership with the Secretary of State. And the ownership is sometimes differed here in the partnership agreement. General partners are usually fully and personally liable for the debts and obligations just as they are with a general partnership. But the different class here is that limited partners have limited personal liability for the debts and obligations of the limited partnership up to their initial investment. So if the business went up and became insolvent and you had debt collectors coming, the limited partners are only going to lose up to what they fronted to start the partnership or what they've invested in it, whereas the general partners can be held fully and personally liable for all the debts and obligations to go with that. Business affairs are typically managed by majority vote of the general partners unless the partnership agreement gives the limited partners some sort of management rights. And this is also treated as a pass-through entity like a general partnership, but the shares of partnership profits and losses are determined by ownership shares specified in the partnership agreement. So something to know here is that if there is a law out there on the books for this, 9 times out of 10, the default provisions in the law can sometimes be contracted around with partnership agreements or whatever the forming agreement is, the bylaws or whatever, if they're allowed to be contracted around. But if not, those laws kind of serve as a default in place. So again, if that's not there in the agreement, there will be some default either in common law or in statute for that individual jurisdiction. And the disadvantages here, this is a little bit more complex than a general partnership, and there's some more formalities, and there is unlimited personal liability of the general partner, and there's more complex control and management because you have that two-step layer there. Now, something that we see a little bit more of, and you might see it in different capacities, is a limited liability partnership. And it's a partner in a registered limited liability partnership is not personally liable for the debts and obligations, and is not personally liable for the debts and obligations of the LLP arising out of the negligence or wrongful acts committed in the course of partnership business. So you're not liable for the financial debts and obligations or the legal debts and obligations that come out of this. But because of this, it's just basically like a general partnership, except instead of general partners, everybody is essentially a limited partner. The only thing is that basically the rules here still apply, notwithstanding the liability shares with that, because there could be a partnership agreement out there that specifies otherwise, with this being a limited liability one. Similarly, what we see a lot of, and this is the one that is very popular and throughout limiting legal liability, is the limited liability company, which is a hybrid between a corporation and a partnership, in which the owners have limited liability as well as the benefits of partnership tax treatment. So it's a separate legal entity created under the laws of the state or tribe, and it's owned and operated and managed by its members. And it combines the tax and management characteristics of a general partnership with the limited liability of a corporation. So with that, you have articles of organization that create this, and operating agreements control the affairs of the LLC, similar to what a bylaw would do in a corporation. And the members of an LLC nor the managers are personally liable for the debts of the LLC. And you can elect how you want to be taxed here. You can elect to be taxed as a corporation, which we'll get into here in a second when we go over the corporation, or as a partnership where you're treated simply as a pass-through entity. And some disadvantages here are the LLC doesn't have the same continuity and continued existence upon death, bankruptcy, or withdrawal of one of its partners. There are multiple formalities and costs to maintain an LLC. Some jurisdictions require you to have a certain degree of a liability insurance to form an LLC, or even to have an office at home in that state, or in some cases tribes. You have to carefully draft the articles of organization regarding control and management, because there's typically more members in this. And then some states allow for a family farm LLC to take hold here. So the LLC is popular because, again, you have that limited liability aspect, but you can decide how you want to be taxed with that. So it's a little bit less rigorous in terms of the formalities of a corporation. So you can kind of have maybe a smaller business model in your mind, like a partnership, but the taxability is more flexible than it would be as a partnership. Now, a corporation is what is everyone's familiar with the big corporations out there: Apple, Sony, Microsoft, and mainstream. You think of corporation, you think of maybe Wall Street. And these are separate legal entities created under the laws of the state or tribe and owned by stockholders, which are the owners of the corporation, governed by a board of officers, which are the policymakers, and then the employees and officers of the corporation managing the day-to-day activities. The articles of incorporation and bylaws, the articles are what you file with the Secretary of State, and the bylaws determine the internal governance. You may be required to submit annual reports to the state or tribe, and stock is issued that reflects ownership in the corporation. The corporation is not dissolved upon the death of a stockholder, director, or an offer. It can also be different classes of stock which are linked to different voting rights, which would be spelled out in the bylaws. The corporation remains in existence as long as stockholders want it to continue. So you do have a little bit more perpetuity of the entity continuing going there. Stockholders are not personally liable for the debts and obligations. It's kind of like that limited liability aspect of a limited liability partnership or an LLC. The liability is limited to the amount of the investment in the corporation. You can tax as a corporation or as a partnership depending upon management and control. Can be a structure that allows for growth and stability of the business. The difference of the difference is that it's more complex to set up and maintain, and if it's not adequately funded or maintained, it could be considered a sham, and the stockholders will lose their limited liability in some instances, and also have to keep personal income and assets separate from the corporate income and access. And there's two different types here. Subchapter C, regular corporations are taxed as a separate entity, paying dividends to stockholders. And then there's subchapter S, which are more of the closely held corporations, and these are taxed as a partnership, and the incomes, deductions, and credits are passed through to the individual stockholders. So you see kind of that two layer is that if you're in the subchapter C part, the entity is taxed itself, but then the dividends to the stockholders can also be taxed as income to the stockholder. So that's when we see that two layer of taxation, whereas the subchapter S is more of a pass-through entity, like we've seen with the partnership, and that everything goes directly to that second layer, with the owners being the stockholders. A couple notes here for agricultural corporations. There are some states that prohibit corporations, trusts, LLCs, LPs, and corporate partnerships from directly or indirectly owning, acquiring, or otherwise obtaining or leasing any agricultural land in that state, kind of to make sure that it stays with individuals. But there are some states that allow for certain types of business organizations to do these things with ag land. But some states restrict these entities to family farm corporations and authorized farm corporation, limited liability agricultural company, family farm limited liability agricultural company, limited agricultural partnerships, family trust, and authorized trust or testamentary trusts. Some of these laws require that the persons be natural persons, so you can't have a corporate, kind of a shell corporate owner, I guess. Related as a family, and a certain percentage or numbers of the persons must be actively engaged in the farm and ranch or live on the land, kind of mirroring some of the crop insurance and things that USDA programs have kind of similar regulations, that there'd be some sort of active management with that as well. Another way to look at these are some key items to focus on. We have the private for-profit corporation, which is a subset of the corporation that we kind of covered overall. Agricultural cooperatives, nonprofit corporations, and membership associations are some other things I'll discuss here. The first is the private for-profit corporation. As with any corporation, the business model kind of follows a for-profit purpose. Authorized to acquire assets and make management decisions and take actions to further that purpose. Again, you see shareholders as the owners, and there may be employees of that corporation, and the owners may lease land to the corporation. And this is best for smaller businesses that have enough cash to fund the creation and maintenance. Think of this as kind of the closely held corporation. Landowners who are also in business together, farming or ranching or conducting activities on the land. Some advantages of this is that it allows to build individual wealth and increases capacity of individuals to manage sophisticated entities. But there are some drawbacks to this, and it's limited capacity, and that it's vulnerable to changes in management and leadership. Because again, think of the smaller entity, think of how closely held this is, and with changes in leadership, that's going to be more of an impact because there's going to be less owners in the business. There's limited political power with these because of their size. Think of the economies of scale. There's limited access to public resources in terms of funding, and you would often need support of other organizations like a tribe, a tribal corporation, or an educational entity to kind of raise those resources. The business entity that we get a lot of questions on is the not-for-profit corporation, or also known as nonprofits. And these are established as a community goal. So maybe kind of a philanthropic goal. Keep that in mind, like maybe some sort of community garden might be owned by a nonprofit. A board of directors is set up to ensure that the organization is managed to accomplish the stated purpose. And you may hire staff. Usually the staff on nonprofits is small, depending on the scale. You know, they can also go as large as they need to accomplish that mission and manage the the affairs and assets. There may have programs to educate individuals and businesses. And the interesting thing is that a nonprofit may own or lease land, and then it may sublease that to a for-profit business. But this can also be subject to corporate tax on unrelated business income, because that, the structure is not for profit. So if you're generating some sort of revenue in that stream, you might have some unintended tax consequences with that. And these are likely a good fit for a motivated community kind of wanting to accomplish that philanthropic goal, kind of united together for that, a particular place that is loved and cherished by the community. A lot of times, again, if you're looking at maybe doing some sort of community garden or community organization to do education and outreach on a particular piece, maybe with doing like agricultural education on traditional farming practices, that might be an example. It's good for land with high cultural conservation and recreation potential, and land well suited to an economic development project are also good fits. The good thing here is that you can fundraise, and if you have the 501c3 status, then the contributions made to your business are tax deductible. It increases the capacity of individuals in the community to manage sophisticated entities. Some of the drawbacks is that you don't build individual wealth because profit is not the focus. And you may or may not be good at individually building that indirectly building the individual wealth. It likely works best in concert with many for-profit entities. So think of individual farmers and ranchers and others who have businesses that benefit from land being well managed. And again, talking about that area of mission creep that we alluded to earlier. If you've set up a nonprofit for a particular purpose, you have to stay within the scope of that purpose, because if you start taking on projects that are a little bit outside that purpose and you're subject to maybe an audit or some sort of IRS inquiry, you might lose that tax exempt status, and that may cause the business to fall through. I guess if you got out of that, you might lose the tax benefit and might have to do some sort of modification to your mission to make it germane to that. Another entity not to be confused with the nonprofit corporation is the not-for-profit membership association. These are formed to accomplish mutual goals of membership, but not for the purpose of earning profits or returning profits to the members. You may not receive tax-deductible organizations if you're a membership organization, but you do not pay income taxes on any profits derived from membership activities. And examples of these are in agriculture are those that represent political interest of members at tribal, state, or federal level. An example might be the Farm Bureau would be an example of this, being a membership organization. Some membership organizations are purely social. For example, they're formed to operate and own a recreational facility such as a rodeo arena, or example, maybe a county livestock show. Some things like that might be something you see in the smaller areas. Likely a best fit for a motivated group of business owners. And the advantages here that you don't have the overall regulation that you would sometimes see with a charitable corporation, a nonprofit corporation. And it does have that increased capacity of individuals and the community to manage sophisticated entities because you have more people. But again, you don't build the individual wealth because you're kind of coming together for a kind of that nonprofit purpose. You may or may not be good at indirectly building the individual wealth. Again, we see that. And again, working in concert with many for-profit entities. You see kind of sister entities maybe sometimes set up with these organizations. The big piece of this discussion is going to center around agricultural cooperatives. And these are businesses that are owned and controlled by the people who use its services. So the thing you need to think about this in three ways: that it's all member focused, it's member controlled, member owned, and member benefited. There are no shareholders like a corporation. These focuses the service at cost. The benefits of a cooperative are proportional to the use that's put into them. The democratic control, usually it's the one vote philosophy, and there's a limited return on equity because the focus is that return to the member. And there are often four major categories. You have producer cooperatives that are formed by farmers, craftspeople, and other producers to purchase supplies or services and to market products. You have consumer cooperatives to buy products like groceries, financial services, think of credit unions and other goods and services, employee-owned cooperatives who are owned by the people who work there, and business cooperatives, which are owned by for-profit businesses, cooperatives, or other nonprofit organizations. An example would be wholesalers owned by retail stores or fast food franchises. So kind of a broad scope there, but these are largely follow that same model of being member focused and being benefiting the people who use them. Again, the business model, you're typically purchasing on behalf of members or marketing the members' agricultural products. We see this a lot of times in rural utilities and other community functions that are trying to be accomplished. These entities are authorized to acquire assets and to make management decisions to accomplish its stated purpose for the benefit of members. Profits shared in proportion to the member use of the co-op services. And again, we see that one member, one vote philosophy. And this is likely a best fit for someone in a group that wants that egalitarian management despite the disparity of financial contributions. So, you might contribute a lot to the cooperative, but you're only going to be limited to that one vote. Whereas with a corporation, your ownership and your control would be proportionate to the shares you owned in the company or the investment that you initially put in. A group that wants to purchase inputs efficiently or aggregate their product to market efficiently. So think of it as increasing your market power by pulling the resources together, that economies of scale thing. If you're familiar with those philosophies, it's the more you get together, the bigger yardstick you're able to measure with in terms of your economic power. Rural utilities would be another example, and owning and sharing specialized equipment or facilities. So if it's a services kind of focus, that might be one. Further in this discussion on agricultural cooperatives is that you can create and build individual wealth because the focus is on the individual, and increase capacity of individuals to manage sophisticated entities. But again, there are some vulnerabilities because you have limited capacity, vulnerable to changes in management and leadership, especially with the smaller that it gets, limited political power and a limited access to public resources, and the need for outside support from tribal entities might be sometimes needed. But the good thing is that farmers can own and operate and control cooperatives and have more control as a group over the types of services and the operations that will maximize their individual farms or businesses, because again, the goal is on the individual, not on the entity itself, to generate revenue for profit to be retained. You can maximize the prices for products marketed and lower the price of supplies purchased, reduce the per unit handling of processing cost, distributing the farmers' net savings and handling, processing and selling, upgrade in quality of supplies and farm products, and development of new markets. So think of it like this: if you're trying to get your grain in the market, you can contract with the elevator on an individual basis, or which is going to have a lot of transactional cost for individual members, or all these members can pull together in a larger cooperative and do one transaction, which is going to have both more economic power and the reduction of individual cost, because those are all pulled as part of a cooperative. So that's one example that we sometimes see. The disadvantages, what happens when members diminish their involvement is that they sometimes have less benefit, and some people don't want to act democratically in some instances. And then there's federations of cooperatives, which are cooperatives that work with other cooperatives. And sometimes we see that in terms of, like I said, credit unions are an example of a cooperative. And a lot of times, as you see that federation of cooperatives, if you're banking with one credit union, you are often able to use the ATM of another due to that federation network that they've all agreed to work together and allow access to one another's ATMs for each other's customers. Switching the discussion a little bit here, I'm going to talk about the Model Food and Agricultural Code project. This is the piece where we have gone in and developed a model set of laws for tribes at the initiative. This was originally brought about by our founding director, Janie Sims Hipp, and it serves as a model resource for tribal governments, providing a comprehensive set of model laws for review, adoption, and implementation. And the model laws contained in the code were designed by IFAI and contributing attorneys to facilitate agricultural production, food systems development, and health outcomes improvement for Indian country. We had support from a variety of outside entities mentioned here: Agua Fund, Farm Credit, Mazone, A Jewish Response to Hunger, the Novo Foundation, the Shakopee Metawakan Sioux Community, and the W.K. Kellogg Foundation. So we had very generous support and are very appreciative to our funders for that. And this is a very large body of law, but the section I would point you to, if you're interested in getting some laws on the books for this, or maybe finding a way to update your code and include other things and seeing what other tribes have done, I would point you to the last chapter, which is the agricultural business entities chapter of this. This is, but again, there are other areas if you're interested in developing this. We can have an offline conversation about that at some point, and I'll provide my contact information at the end of this. But again, I would point you to the agricultural business entities if you're looking to adopt some code relevant to this discussion. The code, again, we developed this with our attorneys and external partners, the Intertribal Agriculture Council, Columbia River Intertribal Fish Commission, the Public Health Law Center, and tribal governments. This was part of a 3-year process. Year 1 was kind of a needs assessment, figuring out what would need to be addressed in Indian country in this regard. Years 2 and 3 were more research, drafting, and revision. And last December, we released the code, did a public release of this, and it is available at tribalfoodcode.com. You're able to get on there. All you have to do is sign up with your email and a password and to create a free account. When you get on there, you can view the code as an all-in-one document, which is over 800 pages, or you can just scroll down and click the individual section that you're interested in that chapter by chapter view, and you can view the business entities section if that's what you want. And the code is a foundational document. It's just as a starting point for tribes to exercise sovereignty in this food and agriculture space. But again, it's something that would have to be adapted for your individual tribe's use. We can be a resource for technical assistance with this, with attorneys that are either your in-house or contract attorneys to help tailor this for you. We can provide that strategic planning on tribal law and policy in food and agriculture, analysis of federal or state law were those considerations for tribes and food and agriculture regulation, information on emerging issues in federal agricultural policy. One is an industrial hemp we've been getting a lot of questions on, and the impact that's having on Indian country. We're currently working to schedule a series of regional policy roundtables around Indian country to walk through this code. If you're an interested tribal leader, tribal attorney, tribal food systems advocate, or any other tribal stakeholder interested in learning more about this code or having some individual discussions on how this could be implemented for your tribe, you can email Whitney Sawney, who is our communications director, and it's kind of our general point of outreach for these items, or you can feel free to reach out to any or all of our attorneys on this. And with that, my contact information is here at the end. My name is Blake Jackson again. I am the policy officer and a staff attorney here at the Indigenous Food and Agriculture Initiative.